Hello, YouTube. I hope you guys are doing wonderfully. On my side, I'm kicking. I'm still kicking, guys. So we're still here talking about step index. For those of you guys that are new to this YouTube channel, this is the main instrument that I trade. And if you can look at the previous commentaries, you can see that I know what I'm talking about. So it's a pair that I've been following for quite some time. Hey, I think it's been like 5 years or 6 years since I've been trading this pair. So I know the ins and outs of this market. So I'm just going to be teaching the model that I trade, and I'm going to be borrowing you my experience so that you can see price action the way that I see it. So for now, you're new. If you are new, then I'm going to make this a little bit easier for you. Today, we're just going to be talking about the psychology part of trading, and then we're going to touch on some price action that we are seeing here on the chart. So which one is first? Is it psychology or is it your strategy? Which one is it, guys? Which one do you mostly focus on? Well, I can tell you this. You are a trader, and if you're a trader, you have emotions. I also have emotions, and there are times when my strategy is tested, and then I begin to doubt my strategy because I would be fearful of a lot of things. Okay, there's money on the line, so I'm fearful of losing the money. See, there's a lot of fear-based decision making because of our emotions, and the market really brings those emotions to the surface. It really does. It's designed for that exactly. It's there to bring forth your emotions, your thoughts and deepest desires. It brings it all forward and you're being tested. Okay, so the market is nothing but a test of life, guys. Nothing but a test of life. Okay, so you need to understand that each and every day, each and every time that you do something here on the markets, there's going to be obstacles in the way. So you need to have systems in place so that you don't lose your money. Okay. So for you to control your emotions, that is where you introduce psychology. Psychology is, in my definition, a way to regulate those human feelings, because you are not a robot. If you were a robot, we wouldn't be talking about psychology, all right? So you're human, and when I pinch you right in your hip really hard, you're gonna scream really hard, okay? So you have emotions, and in the marketplace, those emotions, they play a huge role on your performance. You need to introduce psychology into your trading system to regulate those emotions that are sometimes heightened. You know, those emotions do get heightened, especially if you trade with a big lot size. Every movement of that ticker price is affecting your mood, because now you have placed a big bet on the marketplace. You do trust your strategy, but then you have over leveraged on that particular trade. So you have heart palpitations as the market is fluctuating. So you see where the problem lies. It's the emotions. That's all there is. So how do you regulate in that specific trading session where you are having heart palpitations, you're panicking because every ticker down or higher is affecting your account balance? So how do you regulate that? Obviously, by reducing the risk. Easier said than done, right? You want to make money, but you also want to keep that money. So you need to introduce systems in place that make you money. Okay, so that's all that I'm about here in this YouTube channel. It's really the second time or third time, I think, I've spoken about psychology. I've really just touched on it. So far, I've just been doing price action lectures. So now I am recalibrating my brain and saying that it's the psychology part that needs to be balanced first. Because you come into the marketplace, maybe you're tired, that's an emotion. And you come into the marketplace, you can't focus, you're drowsy, you're not following your plan. So you're gonna make mistakes, and those mistakes are gonna make you agitated. And then that's where you go on tilt. See that? It's really easy for you to go on tilt. So you need to guard your emotions at all the time. But nonetheless, let's talk about price action now, okay? I think I rambled enough about your emotions and how you need to have systems in place. Make sure that you don't lose yourself in these markets, guys. You need to protect yourself. That is your shield. If you don't have that, then you're gonna be in trouble. So here it is, step next on a daily time frame. There's a certain model that I specifically trade. It's the ICT 2022 YouTube model. It has some market making models into it. If you're looking on a daily time frame, you're going to be incorporating a lot of those market making models in your analysis. Okay, so essentially that's what you want to be doing on the daily time frame, because market maker models are the highest form of, how can I say, it's that one model that you always want to be looking out for, because it prints money. It prints money. I think the market makers are using that model to facilitate the market, because that very same model is there on every time frame, every hour, every day. It's there. There is a certain model that I touched on, how the market makers deliver price. They essentially use a model, and it actually goes in this very same manner. Okay, I've explained it so many times. We start here in January. This is the 21st, I think, of January 2026. This is where we created this daily low, and it had this very huge wick. Okay, so whenever you see a wick, you always want to associate that wick with inefficiency. So an inefficiency is associated with a wick. So if price is trading above that particular 50% of that wick, it signals a bullish signature. So here it is. It's been beautiful on the upside since the beginning of the year. So they've accumulated those long positions in January. So they had a target right here in December. So they took out the December high, and they may have hedged their positions and entered above this particular high right there. So essentially, there are two key levels that the market makers are always utilizing. Some say it's your support, some say it's your resistance, some say key levels. Okay, well, essentially it is these highs and lows that you can't ignore. Your eyes is running back to this low and this high. So these are your key levels, and the market makers, they accumulated down here back in January, and they took their profits above this high in December. So in May, they've accumulated short positions, I can tell you that, right? And somewhere here, maybe they may have been closing their long positions, right? They were given enough time as price was consolidating in here to close off those long positions, because they see now that they are not permitted to hold those long positions. So what do? They close, and then they go counter trend now. It's the middle of the year, we go counter trend, and if you look at the June's commentary, I did explain this very same model here. So here it is, right? I'm gonna put it in a different color, let's say this red. So we took out the buy side liquidity. Smart money has accumulated shorts above this high, and on this fair value gap, it creates another market structure shift here. So whenever price action is coming back into that, they are accumulating short positions. And how are they doing that? Essentially, they are utilizing this fair value gap, and the 50%, which is the consequent enroachment of that fair value gap, price action, if it's bearish, it needs to remain below that 50%. See that? That's beautiful. So we had the counter trend in June's price action. We went lower to attack the sell side liquidity down here, right? So that is the ICT 2022 YouTube model. We took out the buy side liquidity, we created market structure shift, we displaced lower with a fair value gap. We came back into the fair value gap, and we respected the fair value gap to the downside. And I spoke about it in June's commentary. You need to check it out, guys. So here we are in July's price action. We print the internal range liquidity. We go down to finally attack the January sell side liquidity. So what have we done so far? We've tagged the upside liquidity, the buy side liquidity, I meant to say. Then now we grabbed the sell side liquidity. So we have printed this fair value gap in the contrarian trade setup of July's price action. Around the 20th, I do expect some kind of a retracement back inside of the range. So it usually creates these huge inefficiencies. So price action had this huge retracement back into the mid-month of July. So whenever I'm trading, each and every month, I'm going in and looking for specific highs and lows in the mid-month. So I try to do a short around the opening of August, utilizing the very same mid-month fair value gap. And that was a pretty good idea all the way down into this fair value gap, the yellow one, okay? So we've come back down into the yellow fair value gap. Let me zoom in. This is the price action that I want you guys to see, honestly. And what we want to be doing with the fair value gap, we want to see if it has a willingness to stay above the 50%. And if it does, then that's good. It signals that there is some accumulation in the upper half of that fair value gap. So the fair value gap consequent enroachment should be respected if we are bullish. And yes, it is. That's a bullish confirmation. Another one is that we are not leaving any candlestick bodies inside of the fair value gap. What does that mean? It means that we are extremely bullish, sir. We are very, very bullish. So where are we going to go if we are bullish? Well, ICT teaches that we need to look for relative equal highs. So here are my relative equal highs. I got the August initial high. It's nested with the mid-month of July's price action. So these levels, they are in the crosshairs because we have supported on the contrarian trade fair value gap right here. So as I said, in the mid-month, I'm looking for a high or a low. So here we have the low, right? Coming all the way down into the constant enrollment. So what is it doing down here on the 13th of August, sweeping sell-side liquidity? Okay, so we're going to talk about that in the lower time frames. But essentially, where we are going is relative equal highs. So I've got this here. These are pretty easy to see. This is the internal range liquidity. And ooh, look at this. That is your buy side liquidity. And here, that's your external range liquidity. So those are the liquidity pools that I am looking for. Okay, I am bullish. So another thing that I wanted to talk about is the market maker models. Okay, the market maker models operate in this way. Okay, so here, going all the way down into the January low, essentially what we were experiencing is what we call the market maker sell model. Okay, so this sell model, it goes on like this. Smart money sells short above this high. Why is smart money selling short above this high? Well, it is because there are individuals that are looking at that high and they anticipate that the market will continue going higher. So the market breaking above this high, they're looking at that as a market structure shift on the upside. So whenever price action would come back lower, they are trying to buy the market. So some may try this as a support and resistance type of an idea, but then it goes lower and fails and further continues going lower. So how would you participate in this market maker sell model? Okay, well, you can't sell short above this high because you don't have the experience. Even I don't do that. I've been trading for 5 years and I don't even do that. I don't trade above this high. Okay, it's really bullish for me to trade short. So I wait for the market to move away from this high. And what does it do? It leaves these fair value gaps. So when price action is trading inside of this fair value gap, that is a low risk sell. So the very first inefficiency that forms after a market structure shift, that is your inefficiency that you're going to trade. Okay, beautiful people, that fair value gap there is being respected as a constant enrichment. So what is it telling you? It's bearish. And whenever you see fair value gaps not being laid with candlestick bodies inside of them, it's absent with a candlestick body. So we only have wicks. That's all that I'm saying here. That is extremely bearish. And then we get this one with a market structure shift. That is when my eyebrows were raised after this market structure shift right here. We had this huge fair value gap going to the downside, and we had stayed below the 50%, right? So essentially we are achieving two things here. We are taking out the buy side liquidity and we are respecting the 50%. And then it goes lower. Okay, so each and every time we have this structure, the market will want to pull back into the range. After we sweep an old high or an old low, price action will most likely want to come back inside of the range. It's all about timing. It's all about timing, guys. Anyways, let's go on into the market maker buy model now. So since this is the sell model, the buy model is quite the opposite. So we had our sell side liquidity being taken here, and then we have our fair value gap right here. We have a market structure shift. This low, we are not treating it as a resistance. Do you see that? We are going higher. So then this low to here, so this low was swept and we traded inside of the fair value gap. What have we done in here? We have swept this particular low and we are accumulating down here. What is happening below this low? Smart money is accumulating. Okay, they can accumulate by sweeping an old low and then go higher with it. So if it sweeps this particular low and closes below it, what are retail traders thinking? They're thinking that the market is going to continue. That is the problem. Price action is reaching down into a discount array. This is a deep discount. How do I know that is a discount array? Take your Fibonacci from that high down to this low, get the 50%. Actually, let me just do that. Giving you guys a masterclass session here. Okay. But otherwise, this is what we have. So we are mingling with this price action here. So let me go ahead and reverse these particular key levels. All right. So here is the 25% of the dealing range from this high down to this low. What makes this a dealing range? It's because the lows are sweeping this old time low, and this high is sweeping an old high. So we have made a new dealing range. We can trade inside of the dealing range. How can we do that? Well, there is internal range liquidity. There is the initial August high. There is the heart of July. And the heart of July is above the 50%. So it is a premium high that needs to be violated. And above it, we got this fair value gap here. Let me just take it from here. We've got this fair value gap. So all of these key levels, they are what? They are premium key levels. So this is where we want to see price action trading from discount to premium and from premium to discount. Does that make sense? So this is the model, guys. This is the model. Okay? If you're not seeing this on the daily time frame, then you're not going to see it on the lower time frame. So if you don't understand where price action is going on the daily time frame, you have no intentions in being in the lower time frames. So because I know where it wants to go, I am now allowed to go into the lower time frames, like the 1 hour. Okay? So here is the hourly time frame, and we've had some pretty interesting price action here. So here is what I'm going to do. I'm going to include the session breaks so that we know what we're dealing with here. Okay. So these session breaks on the hourly, they tell me some pretty interesting information, especially around the new opening day. So whenever I'm on the hourly time frame, that is my initial thought. I want to know how price action traded in the beginning hours of the day. But before I can do that, I need to go back into the previous days, previous week's price action, so that I can understand where is the internal range liquidity. So yeah, I know price action wants to go higher, right? And I had given you guys the buy side liquidity here when price traded inside of our daily contrarian trade fair value gap, and I took out this fair value gap here to here, and essentially I was looking at that and saying, okay, we've respected the fair value gap here, we've traded into a daily time frame key level, and our hourly time frame fair value gap is laid on top of the daily fair value gap high. Do you see, guys? Isn't that wonderful? It's laying on top of it. So it's pretty easy for it to want to gravitate towards the upside because there's a whole lot of key levels from the daily now to the hourly being congested together here. So it makes it a formidable trade to go higher. So when I was talking about price action somewhere here, I said that we want to see it now going higher and higher. Well, there is something that price action tends to do between Wednesday and Thursday. Wednesday and Thursday, they're like the middle of the week. So here is the Thursday's price action here. And look at what price action is doing. All right. It prints more buy side liquidity near this high and this fair value gap here. All right. After printing those relative equal highs, it then trades lower back into the sell side liquidity. And going down into the sell side liquidity, what are we doing down here below this low? We are hitting the 50% of that daily fair value gap. We are essentially rebalancing from the daily fair value gap high to the daily fair value gap consequent enrichment, and we are not allowed to trade below the 50%. So this is what price is telling me, is that they've accumulated down here below this low. They've created a displacement on the upside. There's a market structure shift here, and there's a fair value gap. And notice this fair value gap is also hugging the daily fair value gap high. It's very close to the daily fair value gap high. So that's why I am mentioning fair value gaps that are close to the daily fair value gap key levels. Remember, these key levels on the daily time frame, they are three: the daily fair value gap high, the consequent enrichment, and the daily fair value gap low. So each and every fair value gap, order block, PD array, whatever it is that lays on top of those three key levels, it needs to be studied because that's where your high probability setups occur. Okay, just look at the respect on this. Wonderful. And you know, guys, where price wants to go. So we are printing more buy side liquidity up in here, and we are having a retracement. So we've retraced all the way down into the fair value gap, and we have respected the fair value gap. We have traded above the fair value gap high. We respected the fair value gap beautifully, and we are taking out sell side liquidity. All right, go lower into the fair value gap, accumulate long positions, and then boom, there's the high that we need to target. So I've added some annotations with today's price action. The hourly is just a way for us to gauge the intraday price action. So now that we've transposed those daily key levels into the lower time frames, we can then anticipate each and every single day our bullish bias. So whenever we anticipate this model occurring, right? Since we had the sell-side liquidity being taken here, we had the liquidity purge, and we came to the 50%. We respected that beautifully, and we printed some market structure shift above this high here, and this high, and this high, and this high. So that is pretty telling as to what the market wants to do. So on this key level, on the daily time frame, this is how I would want my price action to be, right? I would want to see price action moving like this rather quickly, right? It's in a hurry to go somewhere. That's how I would call it, as opposed to the price action that I showed you in the 15th of August, where price was coming into this fair value gap. And as you can see, we're having a bit of trouble going higher because we are having some kind of like a consolidation here. So this I would describe as a high resistance liquidity. High resistance liquidity is price action that is not going quickly into its main objectives. For instance, we did not get the buy-side liquidity that I was looking for here. We only came to take out these buy-side liquidity, and then we came back down into the sell-side liquidity. So after that sell-side liquidity has been taken, is then price is printing low resistance liquidity trade conditions being described with inefficiencies. Okay, inefficiencies that are being printed like these is pretty significant. So I would like the one that is trading near that daily key level. So that's why I talked about this fair value gap. So there is the intraday model that we would like to indulge on in the 1 minute time frame. So let's hop into the lower time frames and unzoom a little bit. Man, we're going higher. So let me include the session breaks again. Just want you to appreciate where price is coming from, right? So we had this consolidation, and then London, as we know it, it opens at 1 a.m. right? So here is our London session, grabbing here the sell-side liquidity, printing the London session low near our hourly time frame fair value gap. It hovers above that London fair value gap, and then it goes higher, prints the London high at 5 a.m. 5 a.m. as well is taking out the buy-side liquidity pool here, and then it goes back into the range. Here comes the New York session, all right, 6 a.m. That's when we open our New York session, and it trades below the 25% quadrant level, and it hits it as a resistance, goes lower, attacks the London low, accumulates inside of the hourly time frame fair value gap. And then we had those fair value gaps again, right? After we take out the London low, we are essentially looking out for those fair value gaps that are bullish. So the fair value gap that I would see is this one, right? But as you can see, we did not really trade inside of the fair value gap. Okay, so this would be a breakaway gap, which is essential because we want to see that when we want to anticipate a certain direction. So if I see this big candlestick in my favor, and look at it, it's the 10 a.m. 10 a.m. is where I anticipate a setup occurring, right? So here is 10 a.m. In the real world markets, we know that the 10 a.m. hour is the second round of the New York session news release. Did you guys know that? It's the second round. When is the first round? Well, it's in the 8:30, which is somewhere here. Here is 8:30, And 8:30 is the first round of the market news release in the real world, not in STEP index. Okay. So the first round of news in the real world trading markets, it prints liquidity. It violates liquidity, and there is some volatility injections. So they mainly focus on the London session high or low. Sometimes the Asia, whatever is close to the price action. So here I'm giving an example of London session. So that's the range that we are dealing with. We've taken out the sell side liquidity. What are we remaining with? Well, if we take the London high down to here, we have those quadrant levels. Okay, and those quadrant levels, we've got the 75% here, the 50%, and the 25%. So any key fair value gap or order block, whatever PD array that you trade, present in this dealing range high to low, we would want to treat that fair value gap or that PD array with the utmost respect. Okay, so we had the 75%. I loved how it printed in here, printing the bullish order block with this fair value gap here. Let us zoom in. Okay, we had this fair value gap in here at the 75%. We came back into it and we are now rallying. So this 75% has also this fair value gap in here. Basically, we are utilizing the London dealing range high and low. That's what we are utilizing. And we are qualifying these fair value gaps that lay on top of those quadrant levels. This one has a volume imbalance, guys. So you need to treat the volume imbalance as well, right there. And the other one that we had was at the 50%. This one was an inversion fair value gap right in here. So we need to change the color of these fair value gaps since they are bullish. Let's give them a green color. Okay. So this one was used as an inversion fair value gap in here. We traded above it. And since it was hugging the 50% of the London dealing range, then we are utilizing it as a stepping stone. Since we are trading above it, we want to see it trade as a support. And it goes higher. And the other one, oh my goodness, did I move that? And the other one that we've had is right here at the 25%. So at the 25%, we couldn't get to it, right? As you can see, we could not get into that fair value gap. However, there are structures that we could utilize in our strategy. We could take this volume imbalance. Do you see that volume imbalance right there? Let me zoom in. All right. Take these volume imbalances. Let's just take the two of them like these, right? Essentially, this candlestick is in suspension because it has a volume imbalance on the upside and on the downside. So this low, 5 past 10 a.m., right, trades inside of this fair value gap. And then it bolts higher. So when we come back, we are coming back into this fair value gap, right? These volume imbalances. We are no longer considering the 25%. Do you guys see that? So this fair value gap, it has another PD array on top of it. If price action is not coming back into the 25%, what does that mean? It's bullish. So we would not want to see it trade at the 25%. This fair value gap is enough to send price higher. Do you guys see that? In the 10 a.m. That's a beautiful trade right there. So how many opportunities have you had today to go higher? Damn, that's a lot of opportunities, man. That's a lot of opportunities. So essentially, there is the buy side liquidity, and we are going higher, guys. We're going higher with this market. So, guys, I will see you in the next video. Hope you guys enjoyed this one, right?